Picture this. It's 2 a.m. You wake up to silence. Not the peaceful kind, the kind where your phone has no signal, your Wi-Fi is dead, and when you check outside, your neighbor's house is dark too. You open Twitter, nothing loads. You try Reddit, dead. Discord, gone. Now here's the question no one in crypto wants to answer. What happens to your Bitcoin? Not in some distant apocalypse scenario, not in a movie. Right now, today, if a solar flare, a submarine cable cut, or a coordinated cyber attack takes the internet offline for even 72 hours, what exactly happens to the $1.8 trillion sitting in Bitcoin? The answer is more uncomfortable than you think. You've been told Bitcoin is digital gold, decentralized, unstoppable, immune to government control, a hedge against everything from inflation to financial collapse. And in many ways, that's true. But there's a detail buried in the fine print, a detail so obvious that most people never actually think about it. Bitcoin doesn't live in a vault. It doesn't sit in a bank. It exists entirely on a network of computers scattered across the planet, all talking to each other through one thing, the internet. And the internet, as it turns out, is far more fragile than we like to admit. So let's run the experiment. Let's follow the thread. Let's see what actually happens when the thing Bitcoin depends on disappears. First, we need to understand what Bitcoin actually is when you strip away the hype. Bitcoin isn't a coin. It's not a file on your computer. It's a ledger, a giant shared spreadsheet that tracks who owns what. Every transaction ever made is recorded on this ledger, and that ledger is copied across roughly 17,000 nodes worldwide. These nodes are just computers. Some run in data centers, some in basements, some in countries you've never heard of, and they're all constantly syncing with each other, verifying transactions, updating the ledger in real time. For Bitcoin to work, these nodes need to talk, and for them to talk, they need the internet. Now here's where it gets interesting. You might own Bitcoin. You might have $100,000 worth sitting in a hardware wallet in your drawer. And technically, yes, you own it. Your private key proves it. But here's the catch. If the network goes down, you can't spend it. You can't sell it. You can't move it. You can prove you own it, sure, but ownership without the ability to transact is just a very expensive screenshot. So let's say it happens. Let's say a massive solar storm hits Earth. Happens every 150 years or so. The last big one was in 1859. We're overdue. Satellites go offline. Undersea fiber optic cables get fried. Power grids collapse in stages. The internet doesn't disappear everywhere at once, but it fractures. Asia loses connection to Europe. North America goes dark in sections. What happens to Bitcoin in hour one? At first, nothing dramatic. Nodes that still have power and local connectivity keep mining. Transactions that were already in the mempool get processed. The blockchain keeps moving, but only in the regions that still have infrastructure. Here's the problem. Bitcoin's consensus mechanism requires the majority of nodes to agree on which version of the ledger is correct. If the network splits, if Asia can't talk to North America, you now have two versions of Bitcoin running in parallel. Both are valid within their region. Both are processing transactions, and neither knows the other exists. This is called a chain split, and it's not theoretical. It's happened before on smaller scales during internet outages in specific countries. In 2021, when Kazakhstan shut down the internet to suppress protests, Bitcoin's hash rate dropped 18% overnight. Miners there kept running on local networks, but they were isolated. Orphaned blocks piled up. Transactions confirmed in Kazakhstan weren't recognized globally. Now scale that to a planetary event. You wake up on day 2. The internet is still down. You try to send Bitcoin to buy supplies. Your transaction gets confirmed by a local node. You think it went through, but when the internet comes back online a week later, the global network rejects your transaction. Why? Because the dominant chain, the one with more computing power, overwrites your version. Your transaction never happened. The Bitcoin you spent, still in your wallet. The thing you bought it with, gone.
Now let's talk about miners, because this is where the economics get truly bizarre. Bitcoin miners are the ones securing the network. They compete to solve complex math problems, and whoever wins gets to add the next block to the chain. They get paid in Bitcoin for this. It's expensive. Industrial mining operations burn as much electricity as small countries. But here's the thing, they only keep mining if it's profitable. And profitability depends on the price of Bitcoin. And the price of Bitcoin depends on exchanges, and exchanges depend on the internet. When the internet goes down, price discovery stops. No one knows what Bitcoin is worth because no one can trade it. Coinbase goes dark, Binance goes silent, the entire market freezes at whatever the last traded price was. Miners, meanwhile, are still burning electricity. They're still competing to win blocks. But the Bitcoin they're earning, it has no confirmed value. They're spending real money on power to earn an asset they can't sell. How long do you think they keep mining? Some will. The big operations with cash reserves, with long-term conviction, they'll ride it out. But the smaller miners, the ones running on thin margins, they'll shut down within days. And when they shut down, the hash rate drops. And when the hash rate drops, the network becomes easier to attack. Normally, you'd need 51% of the total computing power to hijack Bitcoin. But if half the miners go offline because they can't access the internet, that threshold gets cut in half. Suddenly, an attack that was prohibitively expensive becomes plausible. This is the part the Bitcoin maximalists don't like to talk about. You've heard the pitch. Bitcoin is unstoppable, it's censorship resistant, it's the hardest money ever created. And in a world where the internet is always on, where satellites and fiber optics and cell towers all work perfectly, that's mostly true. But the internet isn't unstoppable. It's a web of physical infrastructure held together by cables, servers, and electricity, and all of it can fail. There are redundancies, sure. Mesh networks, satellite uplinks, radio transmission of Bitcoin transactions has been tested. Blockstream even has satellites broadcasting the Bitcoin blockchain 24/7. In theory, you could sync a node using nothing but a satellite dish. But here's the reality. The average Bitcoin user isn't running a satellite node. They're using an app on their phone. They're trusting an exchange to hold their coins. And when the internet goes down, that app becomes a paperweight. Even the hardcore preppers, the ones with hardware wallets and satellite dishes and generators, they face the same problem. They can receive the blockchain, they can store it, but they can't transact with anyone who's not on their local network. Bitcoin becomes a LAN party currency, useful within your bunker compound, useless everywhere else. Now zoom out, because this isn't just about Bitcoin. The entire financial system runs on the internet. Your bank account is a database entry. Your stock portfolio is a number on a server. Your credit card is a network request. If the internet goes down, all of it stops. And at least with traditional banks, there's a physical branch you can walk into. There's a government guarantee. There's a mechanism, however slow and bureaucratic, to access your money. With Bitcoin, there's nothing. No customer service line, no FDIC insurance, no central authority to reboot the system. The network either works or it doesn't. And this is the uncomfortable truth that gets buried under all the talk of decentralization and freedom. Bitcoin isn't free from infrastructure. It's entirely dependent on it. It's just dependent on different infrastructure. Infrastructure that's arguably more fragile, more distributed, and harder to repair in a crisis. The same feature that makes Bitcoin resistant to government seizure, its lack of central control, makes it nearly impossible to recover from a catastrophic failure. You can't call the CEO of Bitcoin. There isn't one. Here's the irony. Bitcoin was invented in response to the 2008 financial crisis, a crisis caused by centralized institutions making reckless bets with other people's money. The idea was to create something that couldn't be manipulated, couldn't be printed into oblivion, couldn't be controlled by any single entity. And it worked. Bitcoin is all of those things. But in solving for centralized risk, it created a different kind of fragility. It traded the risk of human corruption for the risk of infrastructure collapse. The banks might be reckless, but they have vaults, they have backup systems, they have governments that will prop them up when they fail. Bitcoin has none of that. It has code, it has cryptography, it has a network of volunteers running nodes in their spare time, and it has the internet, which, as it turns out, is the single point of failure no one wants to acknowledge. So what happens to Bitcoin when the internet goes down? In the short term, nothing fatal. The blockchain pauses, transactions freeze, miners keep grinding away in isolated pockets, and when the internet comes back online, the network stitches itself together, discards the orphaned chains, and continues like nothing happened. But in a longer outage, weeks or months, the cracks start to show. Miners drop off, hash rate collapses, the network fragments. And the idea that Bitcoin is this indestructible, unkillable form of money starts to look a lot more fragile. Maybe that's fine. Maybe the internet will never go down for that long. Maybe the infrastructure will hold. But here's the question worth sitting with. If your hedge against financial collapse depends entirely on the same interconnected global system you're trying to escape from, is it really a hedge at all? Think about it. If this made you rethink a few assumptions, share it with someone who needs to hear it. And if you think I'm wrong, good. Leave a comment. Let's argue about it. That's what the comments section is for. It takes a lot of effort to create this kind of content, so make sure to like the video and subscribe to the channel. I'll see you in the next one. Bye-bye.